Hello, I'm Peter Herbert from Insight Training. Welcome to this latest in our series of short webinars looking at topical aspects of financial reporting and auditing. Today's session will focus on small company reporting under IFRS 102, Section 1A. We'll begin by talking about eligibility for the small company regime and Section 1A. We'll give a very brief overview of the essentials of this particular accounting regime and focus mainly on a series of frequently asked questions. Let's begin with eligibility. So there are the small and micro limits. When you're below 2 out of 3 of the small company limits, you're eligible for the small company regime and application of Section 1A of IFRS 102. Don't forget the 2-year rule though. If you're shrinking from medium to small, or indeed from small to micro, you can use the simpler regime only when you fall below 2 out of 3 limits for 2 consecutive years. And that's been quite a common issue in the current climate where organisation balance sheets are shrinking in the light of the current coronavirus crisis. Certain entities are ineligible from applying the small company regime. This slide does not give you an exhaustive list, but gives you some of the main ones. So you cannot apply the small company regime and Section 1A of IFRS 102 where you are a publicly limited company. You can't do it where you're a parent company in a medium-sized group, even though as an individual entity, you're below 2 out of 3 of those limits. You can't use IFRS 102 Section 1A when you're a financial services company that falls into one of the categories on the third bullet point on this slide. And although charities aren't prohibited from applying Section 1A of IFRS 102, the Charity Sort Committee has made really clear that they don't really feel that IFRS 102 Section 1A is fit for purpose in the charity world, and therefore, broadly speaking, what charities need to do is apply full IFRS 102 and the Statement of Recommended Practice. Let's quickly remind ourselves of the essentials of the small company regime under Section 1A of IFRS 102. So that gives you an overview. Remember that the basic debits and credits that you do for a small company under IFRS 102 are broadly the same as you would do for a medium or large company. Small companies can, per the legislation here, abridge their balance sheets and P&Ls, and they can adapt them. Adaptation, I find, is extremely rare. Abridging, slightly more common, but not massively so. What that basically means is compressing the P&L and balance sheet information down. The main way that that impacts is that your balance sheet notes for things like debtors and creditors do not appear, and therefore do not appear on the public record at Companies House either. Much more common is unadapted, unabridged accounts, which are filleted for filing purposes, which means that the P&L, the P&L notes, and the director report get removed for filing at Companies House. The key bit that this short webinar will focus on is the disclosures, and the disclosure requirements for small companies under Section 1A are all shoehorned into Appendix C. That's based on relevant EU legislation that came into play broadly for periods commencing on or after 1 Jan 16. But the Financial Reporting Council is very passionate about ensuring that small company accounts do give a true and fair view, and they therefore list in Appendix D of Section 1A additional disclosures that they really feel should go in where appropriate to inform that true and fair view. IFRS 102 has recently been updated by virtue of the triennial amendments, and that came into play from periods commencing on or after 1 Jan 19. That's not substantially changed Section 1A, but the recommended disclosures in Appendix D have now moved to Appendix E for periods commencing on or after 1 Jan 19. There, broadly speaking, are the 13 areas of notes that are required for small companies applying Section 1A of IFRS 102, as listed out in Appendix C. The one I want to highlight here is the exceptional items disclosure. That's the only P&L note in a IFRS 102 Section 1A set as required by the law. And that particular P&L note will therefore, going back to what I mentioned a few minutes ago, get filleted out for filing purposes. Where any other note appears within a Section 1A set, that will appear on the public record at Companies House as a result, given the way the filing regime works and has worked now since 2016. I mentioned recommended disclosures in Appendix D, that's now become Appendix E of IFRS 102. They're to inform a true and fair view, and there are the key elements of those recommended disclosures. Importantly, in the current climate, where there's material uncertainty casting significant doubt on going concern, that's a mandatory requirement for disclosure under FRS 102 for medium and large entities. The FRC feels that although it's not a legal requirement for a small company applying Section 1A, where relevant, where appropriate, it would need to be included in the notes, accounting policies to inform a true and fair view. And as you'll see on that slide, there are 3 or 4 other aspects of that recommended disclosure that also appear there in that particular appendix. So that's a quick recap on the essentials. Let's now move on, if we could, and look at our frequently asked questions. First question we get asked a lot is, how is turnover defined in company law and FRS? This seems important because it partially determines the required accounting regime. We saw, didn't we, on the earlier slide, the small company and micro company limits, turnover, assets and employee numbers. And yeah, unfortunately, in company law and in FRS, turnover is not particularly explicitly defined. It quite simply states in the appendix to FRS 102 and in company law that turnover is amounts derived from the provision of goods and services, and that's as far as it goes. It's therefore, I think, in the real world quite difficult to ascertain what you would include in that total and what you would exclude to basically inform your company status. We always advocate that you should include everything unless you've got a very good reason not to include it. 2, I think that often very much stand out for me as not being part of your turnover, your amounts derived from the provision of goods and services, would be revaluation gains on invested property that will, of course, wash through P&L under FRS 102. That's categorically not going to be part of your turnover figure. And neither in the current climate, I feel, would furlough grants received under the coronavirus job retention scheme. But I think the basic theme with turnover is, if in doubt, include it, even though that might mean that you're applying a more onerous accounting regime and require an audit, which if you do exclude it, you would not. This again is a common question we get asked for a number of sole director companies where they don't take a salary. Are they an employee for disclosure purposes? Again, a lot of people, I think, get quite fixated on employee numbers being based on there being contracts of employment. Not everyone completely shares this view, but our view certainly is that you would not need a contract of employment to be an employee. If you're working in the company day to day, you would be very much, as far as I'm concerned, in scope as an employee, even if you're not formally drawing a salary. If you're in a non-executive role, you absolutely would not be an employee. If you were in an executive role, as far as I'm concerned, you would. But again, going back to the point we made in relation to question 1, given that these particular markers do determine company status, and also that links into the ability to get audit exemption, one would think this would be clearer, but in reality, in law and in FRS, it's not. Third question, the amount of detail in accounting policy notes in FRS 102 Section 1A dwarfs the rest of the notes. Is all this detail really needed? And again, I've got a lot of sympathy with this one. Again, if you do look at a typical set of FRS 102 Section 1A accounts, given there's relatively limited disclosure beyond the accounting policy notes these days, especially if the accounts have been abridged, it can certainly seem that the accounting policy notes kind of almost overwhelm everything else that's in there. So my guidance is always to try and do your best to think about what's pertinent in the circumstances and tailor it accordingly. I think certainly the challenge that smaller accountancy firms have is they've got accounts production going on a big scale. They haven't got, therefore, lots and lots of time to tailor every single set over and above what their proprietary software would suggest that they include. What I would certainly recommend in that situation, and rather oddly, is that the Financial Reporting Council's own financial statements are quite a good point of reference. And what they do in their accounting policy notes is give you a very light touch approach and very much focus on areas whereby some element of choice has been made in terms of approach, because at the end of the day, these are accounting policies, not necessarily a replication of the accounting rules. I think if you were to go onto the Financial Reporting Council website, have a look at their financial statements, it's refreshingly limited in detail, and that again could give you some quite good insight about what you might do in a situation where you're looking for less detail rather than more, to make the accounts more proportionate in relation to actually what's in there in practice. Now, the next couple of slides just give you a flavour of what those FRC accounting policy notes look like. There's no particular judgment as far as they're concerned about how they actually ascertain what tangible and intangible assets are and how they're measured. That aspect, therefore, they do not include. Where they are going to bring judgments and choice to bear is around depreciation, and that's therefore the bit they deal with within that particular accounting policy note. The other aspect we do find that some organisations do go massively overkill on, based probably on what proprietary software gives them, is financial instruments. And again, in the area of financial instruments, it's professionally light touch, lacks too much detail, and therefore I think it makes the financial statements much more reader friendly and proportionate in terms of what's been included. Question 4, are comparative disclosures required where a loan is made to a director of a small company? Well, the answer to this one is yes. Loans to directors are dealt with by section 413 of the Companies Act, and these loans, or as they're formally called, advances, credits and guarantees, do have to be disclosed in accounts for large, medium, small and micro entities. FRS 102 these days provides a broad requirement for comparatives in a whole range of different areas, and basically says that unless legislation specifically precludes the requirement for a comparative, then it will be needed. This area is no exception. Furthermore, section 1A of 102 specifically states that when you do have advances, credits and guarantees in the prior year, these will need to be disclosed in the financial statements. So in short, the answer to that one is yes. So no loan in the current year, but a loan in the comparative year, there would still be a need for disclosure in the notes to the financial statements. Question 5 is one we get a lot. So where a loan is advanced by a director to a small company, does this need to be disclosed in the notes to the financial statements? Again, remember the way this works, that loans to directors are basically advances, credits and guarantees dealt with by section 413, and they go in as a matter of course. Loans from directors, they are in the category of what I would call other related party transactions, and they're only going to go in per section 1A of FRS 102 when various criteria have been met. And the next slide summarizes the way the rules work for loans from directors and loans to, hopefully makes really clear what the circumstances look like in practice. And there it is. So way to the left, we've got the rules around advances, credits and guarantees. That's loans to directors. And as I say, that will apply in small, micro, medium and large. For other related party transactions, what section 1A says there is they would only need to be disclosed when they're not concluded under normal market conditions. And where a related party transaction is concluded under non-normal market conditions, it would only require disclosure when it's with what I would refer to as one of the three. And the three are key shareholders who own more than 20%, investee companies in which the company itself owns more than 20%, and company directors. Now, as far as the example is concerned, in this situation, it's a loan from a director, and therefore it definitely counts as one of the three. The question would therefore be, is that loan on normal commercial terms? If so, that would be normal market conditions and would therefore not require disclosure. If that loan were not on normal commercial terms, it would require disclosure. And again, going back to an earlier point, given this is not a P&L note, that would be in the shareholder accounts and the filed accounts in a way it wouldn't have been under the old abbreviated accounts regime pre-2016. Last question, which we've been getting lots of during the last 4 or 5 months, where a small company has been very dependent on government support grants during the pandemic, should the amounts concerned be disclosed in the notes to the financial statements? Now, one of the overriding requirements, of course, in a Section 1A set is that whatever the law says you have to disclose per Appendix C of 1A, and whatever the FRC strictly suggests that you should include, best practice to inform a true and fair view Appendix E of Section 1A, there may well be other things that need to go in there to inform that true and fair view for the reader. And I think in the current climate where a situation has arisen where a small company has been very much dependent on government support, that would indeed be a relevant disclosure. And in that situation, what full FRS 102 would require in Section 4 is analysis of the makeup of that government grant support and what those government grants relate to. Put another way, one might construe this as being a kind of an exceptional item in the current climate, which would therefore need to be disclosed on that basis as well. So I think where that's been very integral, there would definitely be a need to disclose it. And that may not be massively popular for some small companies. I guess the good news would be, given this is an analysis of a figure in the P&L, although that particular analysis would be to be in the shareholder accounts, because we can, of course, as already mentioned, fill it out, P&L notes for filing purposes, that would not need to go on the company record, public record of Companies House, in the same way that it would be in the shareholder accounts, and that might be more reassuring as far as the small entity is concerned. Okay, so we went through a little bit there on eligibility for the small company regime. I reminded you of the importance of looking at the 2-year rule before you too quickly conclude that a small entity is one when it's not. We talked briefly an overview about the format of the FRS 102 Section 1A rules. That's very much based on European Union law that's changed not at all since 2016, therefore a very well established regime now. And we then finished off by going through 6 frequently asked questions. Some of those are pandemic related and some not, but they're the sort of questions we'll be getting lots of late, and we thought it might be useful to share those with you and give some insights here today. We hope you found the webinar useful. If you've got any questions or follow-up following the session, do drop us a note at inquiries@insight-train.biz and check out our website for more information on our full program of courses for spring 2021. Thanks for watching. I'll see you all soon. Goodbye.